Concepts discussed in Module 3 Part B are from Chapter 3 of Fioretto and Gable textbook, and the chapter name is A Basic Understanding of Financial Statements and Ratio. Learning objectives of this section are to understand the importance and use of retail valuation method, to identify inventory indicators that can be calculated using retail inventory method, to comprehend the steps involved in using retail inventory method, to comprehend the advantages and disadvantages of this method, and lastly to comprehend the use of gross margin return on inventory as a critical method for inventory performance. Merchandise inventory is typically the biggest current asset in retail business. Buyers regularly evaluate inventory value and performance to maintain the path of profitability. Two basic approaches are used to determine the monetary value of inventory: the cost method and the retail method. Retail method of inventory valuation is the most frequently used method in fashion retail business. Taking a physical inventory is costly. Stores need to be closed and people paid for conducting the work. The retail inventory method combines taking inventory at retail prices and adjusting the cost value to reflect current retail value of the inventory. The unsold merchandise that is held in inventory can be assessed when a physical inventory is taken and the quality and the age of merchandise is considered. The retail inventory method can and is generally used in conjunction with the physical inventory. The benefit of taking a physical inventory is that it allows a more accurate comparison of the book and physical inventories. Using retail method of inventory valuation, a retailer can determine the following factors at any time. First, book inventory, which is the value of inventory in hand. Second, gross cost of merchandise sold. Third, maintained markup, which is the actual markup achieved on actual sales of good. Fourth, total cost of merchandise sold. Fifth, gross margin. And lastly, net operating profit. Shortages can also be estimated by comparing book inventory value with physical inventory count. Steps to retail method calculations are: Step 1. Calculate total merchandise handled at cost and retail. Step 2. Calculate cost percent of total merchandise handled by dividing total merchandise handled at cost by total merchandise handled at retail. Step 3. Calculate closing book inventory at retail. Closing book inventory at retail is the difference between total merchandise handled at retail and total retail deductions. Step 4. Calculate closing book inventory at cost by multiplying closing book inventory at retail and cost percent. Step 5. Calculate gross cost of merchandise sold, which is the difference between total merchandise handled at cost and closing book inventory at cost. Gross cost of merchandise can be used to calculate maintained markup, which is the difference between net sales and gross cost of merchandise sold. Step 6. Add alterations and subtract cash discounts from gross cost of merchandise sold to calculate total cost of merchandise sold. Step 7. Calculate gross margin, which is the difference between net sales and total cost of merchandise sold. Advantages of retail method are: this method represents a conservative and realistic valuation of the merchandise that remains in stock. The profit estimates can be calculated more frequently, thus allowing for a better inventory management. This method can show when inventories start to build up and markdowns may be necessary to sell them. When inventory level falls lower than the expected, then rush orders can be placed to balance them out. Value of inventory can also be estimated using this method for insurance purpose. Take inventory at retail means less chance of error as all sales transactions are done at retail value. This method helps in controlling stock shortages. Retailers can go out of business if stock shortages are too high, as they directly influence profits by lowering them. Some of the disadvantages of retail inventory method are that because this method is an averaging procedure, a major disadvantage is that little attention is given to the merchandise assortment that has a wide variation of markups as well as the differing turnover rates. For example, Low markup merchandise usually sells with greater frequency, a higher turnover rate, than compared with merchandise with large markups. The resulting cost figures can easily be distorted. Secondly, because this procedure necessitates a large amount of data and extensive record keeping to be successful, it can be time consuming and care has to be taken to correctly input data. Further, buyers have to be sure to carefully keep records of markdowns and additional markups because they are required to utilize the retail inventory method. Gross margin return on inventory, which is also called GMROI, is a KPI used to measure inventory performance. Managing inventory is the responsibility of those involved in the buying function and is a good indicator of their performance. The basic premise of GMROI is the increased profits through more sales without an increase in inventory. GMROI is calculated by multiplying gross margin percent and turnover and then dividing that by 100% minus markup percent. Inventory turnover refers to the number of times on average within a period that the retailer sells its inventory and replaces it with fresh merchandise. It is calculated by dividing net sales for the period by average inventory. Buyers control both gross margin and inventory. Two major advantages of GMROI are that it allows those in retail managerial position to evaluate inventory by the return on investment it produces, not just on gross margin. GMROI makes obvious the relationship between two important components that can improve performance, the gross margin percent and the inventory turnover. In a period of recession, buyers should make the attempt to increase inventory turnover and increase gross margin. Buyers employing GMROI when planning and making decisions regarding inventory are likely to be more profitable. Management should not employ GMROI to compare one department in a store with another because the assumption cannot be made that operating expenses will remain the same for each department, resulting in the same net profit.